3 p.m. live from our studio in New York City. I'm Julie Heiming. That's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. Markets heading for another down day, and the Nasdaq is again leading those declines. The magnificent 7 stocks on track for their 4th losing day in a row. That would be the longest losing streak in a month. Apple alone losing more than $350 billion in market cap in that span. We're tracking all that market action in the final hour of trading.
And investors also digesting the minutes from the final Fed meeting in 2023. Fed officials appear to be done with rate hikes, but the path of cuts is looking less clear. We're going to break down what we heard from the central bank as the voting board gets a new look in the new year.
Plus, the drama at Disney reaches a new level. Another activist investor in the mix, but this time backing the House of Mouse. We're following the latest developments. Let's get you up to speed on the market action now as we have another down day here to start 2024. Very different tenor than we had, of course, for particularly the end of 2023. The Nasdaq leading declines, as I mentioned, off 0.8%. The S&P off 0.5%, as is the Dow, off by about 180 points. Now, if you recall, yesterday the Dow just eked out a gain at the very end of the session. We'll see if something similar happens today. Right now, energy stocks are the best performers in the S&P 500. Real estate, consumer discretionary, and industrials are the biggest drags. So actually not tech on a percentage basis, although because of the size of tech, it is dragging down the major averages.
Yep, and you know what else? New year, new economic data.
Indeed,
so
yes.
Let's get to that as well. JOLTS data this morning giving us a clear picture of the labor market ahead of Friday's big jobs report. Openings were little changed, nudging slightly down to the lowest level since March 2021, and a signal of ongoing but moderate cooling. And so that was really the signal here, Julie. So U.S. job openings in November kind of lower than where the street was at. 8.79 million jobs open. Street was closer to around 8.82 million, and the quits rate, which economists will look to as sort of a leading indicator of labor market momentum, that fell to 2.2%. So big picture, more signs of cooling in the labor market. And of course, we get the government's big jobs report on Friday. The expectation there, that's going to be 170,000 positions economists think were added in December.
Yeah, and so softening but not, grounding to a halt was kind of the vibe that I got from the economic commentary that I was reading from the various analysts out there. So cracks, as you said, cracks appearing in the jobs market, but nothing that is alarming to folks. Chris Rupke over at Forward Bonds, the chief economist there, saying net, the labor market looks to be coming in for a soft landing, job openings on a downward trajectory. He said it's sure to please Fed officials as they plot their course on interest rates this year. Mike Jarda over at Roth MKM, he's been a little bit more cautious and bearish. He says that basically JOLTS data, even though it's for November, even though it's a lagging data point, can actually be a leading indicator. And so he says it is something to watch here. The labor market should continue to cool here. And he said the neutral policy rate should decline in sympathy.
And cooling here, I mean, if you're Jay Powell and the Fed, that's what you want to see. Cooling, not crashing, but cooling. Because, of course, you want to see that kind of limit on wage pressure and slowing inflation. So this is what the Fed would like to see in the labor market. They of course, still hopeful they can kind of hit that rare, tricky, soft landing, bring inflation back to 2% without a downturn and surging unemployment.
Yeah, and I know we're going to talk about the Federal Reserve minutes from their last meeting in just a minute, but I did want to zero in on something here from the minutes. A few Fed officials said they felt the Fed was approaching a point where the central bank may face a trade-off between its dual goals of controlling inflation and maintaining high rates of employment. And this is something that investors have been talking about for 2024. Is the focus going to be turning more to jobs, right? And we've had a few investors, economists on recently, Torsten Slok of Apollo yesterday among them, who said the inflation fight isn't done yet. So I wonder yet if we will, I mean, people are always going to pay attention to the jobs data, but I wonder if the focus will more exclusively shift now or if it's going to be a little further into the year.
Yeah, the chat with Torsten was fascinating because he did talk about those sort of those upside risks to inflation, mentioned the housing recovery, right? Yep. Well, let's get more on this. The Federal Reserve is out with the minutes of his December meeting. For more on what clues it reveals on Fed officials' views on the economy, we have Yahoo Finance's Jennifer Schonenberger. Jennifer.
Good afternoon, Josh. Officials believed during their December policy meeting that interest rates were likely at or near the peak for the current rate tightening cycle, and almost all participants felt that rates could end 2024 lower given progress on inflation. Now, even though almost all thought that rates could end the year lower, they stressed there's a lot of uncertainty around that, and that the economy could evolve in a way that would cause them to actually increase rates. Many said that an easing in financial conditions beyond what was appropriate could make it more difficult for the Fed to reach their 2% goal. And ahead of these minutes, we saw a lot of divergence in opinions from several Fed officials after Fed Chair Powell made that dovish pivot. And we saw evidence of that in these minutes. Specifically, several said that the economy or inflation might evolve in a way that will require them to hold rates at the current level for longer than expected, while some warned about the risks of being restrictive for too long. Now, one thing that everybody agreed on, clear progress has been made on inflation, but they still needed to see more evidence that inflation is moving back towards their 2% goal. They don't think that there are risks to the upside, but there is a risk that inflation could stall. Now, I do want to point out that Fed officials underscored that they're looking at the 6-month measure on inflation readings. And that's very interesting because if you looked at the most recent read on the Fed's favorite inflation gauge, core PCE, on a 6-month annualized basis, that actually clocked in at 1.9%, so a tenth of a point below the Fed's 2% target. So officials very much paying attention to that metric there. So bottom line here, guys, it does look like rates are moving lower possibly this year, but there's significant uncertainty around that forecast and outlook. It's really going to depend on how the economy evolves.
And also, Jen, we should mention on a separate note, with it being a new year, there are rotational changes in store for the Fed in terms of its voting members. So who's the new group of voting members and what can we expect from them?
That's right, Julie. So every year, 4 members of the 12 regional Fed banks rotate on and off the committee, ushering a brand new set of voting members that could tweak the calculus for how the committee votes to set interest rates. So if we look at this year, not expecting very much of a shakeup in terms of the balance of hawks versus doves. Take a look at who is coming on the committee this year as a voting member. Cleveland Fed President Loretta Mester, she is a hawk. Richmond Fed President Tom Barkin, he's neutral to hawkish. Atlanta Fed President Bostic, who is a dove, and San Francisco Fed President Mary Daly, who is a hawk turned dove. Stepping back from voting this year are Chicago's Fed's Goolsbee, who is a dove, Philadelphia's Patrick Harker, also a dove, Minneapolis's Kashkari, a hawk, and Dallas Fed's Lori Logan, who is also a hawk. So you essentially have 2 hawks and 2 doves who are trading places for 2 more hawks and 2 more doves. So a bit of a wash there. But still, a switch mid-year could lead to a more dovish FOMC. Cleveland's Loretta Mester is set to retire mid-year based on the Fed's mandatory age and length of service policies. So in that circumstance, the alternate would vote, and in this case, it would be Chicago's Austin Goolsbee, who seems to lean a bit more dovish. So perhaps in the second half this year, we could see an FOMC that leans a bit more dovish based on the voting members. Guys?
Jennifer Schonberger, thanks so much. Well, U.S. interest rates are at the highest levels in more than 2 decades overall. And while cuts are expected in 2024, Vanguard economists say the days of ultra-low interest rates are over. So what does this new reality mean for the path ahead? Joining us now with more is Roger Aliaga-Diaz, Vanguard's chief economist and global head of portfolio construction. Roger, thank you so much for being here. So we're talking about rates, we're talking about jobs. I actually want to pick up on the latter first, because you have a forecast for the unemployment rate that is considerably higher than where the Fed is projecting it will go. So talk us through your forecast there and why you are sort of diverging here.
Yeah, absolutely. Yeah, there is a couple of factors here. One of them being we believe that the cumulative effect of the monetary restriction will eventually exert pressure in 2024. Right, 2023 we avoided the slowdown. There is no signs of a recession, and it seems that we are in the path of soft landing. But that is about to turn in 2024, and that alone will lead to lower payroll numbers and higher unemployment rate. But the second factor is that the labor supply, whether led by foreign-born workers and immigrants, as well as early retirees that are coming back, have make a surprising comeback in 2023. That was a significant increase in the participation rate, and that may mean also that that the unemployment rate may go a little bit higher than otherwise in this cycle. So we were expecting 4-5% by the end of 2024, and now we have upped that to 4-8% as part of this Fed-induced slowdown, which is needed to bring inflation down, right?
And Roger, we have plenty of smart economists and strategists on the show. When they look ahead to 2024 here, they see a soft landing. Is that what you see?
No, not necessarily. I mean, certainly it's a possibility. We cannot discard it. Soft landing is an incredibly difficult balancing act, really, to achieve. It has rarely been achieved before, right? It requires basically that the labor market stays strong while the cumulative effect, as I was saying before, of the monetary policy doesn't do much, right? Essentially, we have seen the data coming in support of soft landing because of inflation coming down. But the question that we all need to answer, even the Fed needs to answer, is why the 5%, 5.25% rates are not really hurting the economy. That's something new. Of course, there are many reasons to think about the long and variable lags. We saw the fiscal policy, the debt finance industrial policy in 2023 kicking in very strongly. We saw the labor supply shock I was talking about before. Oil prices behaving incredibly well in spite of the geopolitical risks, right? So all those factors really contributed to that softening in inflation. But some of those factors may turn. Actually, none of these are driven by the Fed, right? And 2024 could be a different picture where inflation, if it comes down, is because the economy is slowing down, which is really the more natural way for inflation to decelerate.
So then if that's the case, Roger, how does the Fed react, right? If maybe inflation is coming down, but not because of them, but at the same time, if we're seeing that unemployment rate tick up, do you think, there's a lot of diverging opinions right now as to when the Fed is going to begin to cut. When do you think that's going to happen?
Yes, I mean, that would push the Fed cutting more towards the June, mid of the year, as they see the unemployment rate going beyond their own forecast for the year. They have 4.1% for the year. If unemployment rates start getting to 4.2, 4.3 mid-year, that's where they may accelerate the cuts.
And Roger, I'm also interested, what do you think the Fed needs to see before they start cutting? I mean, clearly we just saw the minutes. There's some uncertainty about if and when. Is it just, Roger, they need to see inflation come back to 2% and stick there for some amount of time, as well as see the economy slowing?
Yes, absolutely. They need to see inflation in a sustained path downwards. But again, I mean, this is difficult to think will continue without a further softening of the labor market, right? So it's the combination of inflation coming down with unemployment increasing which will actually trigger the cuts by the Fed. What is very difficult to see is what the market is pricing in, right? Because the market is pricing quite a few cuts with no increase in unemployment and with inflation coming down. So in our view, one of two scenarios can happen. Either the unemployment rate increases and the Fed cuts as much as the market is pricing in, or alternatively, you have unemployment remaining at 4%, avoiding recession. But in that case, we don't see the Fed cutting as much, right? So what is really difficult for us to see is this middle ground of more than 5, 6 cuts with unemployment at 4% and with inflation coming down.
So if there are these sort of two binary scenarios here, Roger, how do you approach that as an investor? Is there sort of a middle path that will be somewhat agnostic or that can succeed no matter which of those things comes to pass?
Yeah, the way you're characterizing it is really the right way to think about it. It's a bimodal, right? A binary outcome. So the average of both them is not the most likely outcome, right? And that seems what the market is pricing in. It's almost pricing in the middle of the two. In our view, this binary outlook translates into probably volatility. We think that on the one hand, the Fed may need to walk back a little bit the dovish rhetoric we heard in December. The minutes today are a little bit more neutral to that respect. And also the market probably will have to reprice more the Fed path in one of these two outcomes. So I think we're worried about the short term, this financial easing and this exuberance in risk assets. We may see a little bit more volatility as this repricing happen, right? Medium term, we're more optimistic, but in the short term, we're more concerned about this.
Roger, finally, we've been asking investors, strategists, economists like yourself, maybe if you're thinking about New Year's resolutions for investors for 2024, what do you think that folks should be thinking about?
Yes, well, I think we learned a couple lessons through 2023. One, not necessarily concentrated too much into cash, right? And the 60-40 is basically alive and well, and it has done incredibly well in 2023, up almost more than 15%. So actually, for long-term investors, that probably is a good strategy to go back to. So think about diversification, think about balance, especially for investors that may have more of a long-term goal, but they're not looking to outperform a benchmark on an annual basis.
Roger, thanks so much for joining the show today. We appreciate your time and insight.
Absolutely. Thank you.
Let's get to some trending tickers now. Shares of SoFi sliding today after KBW downgraded the stock to underperform from market perform, warning the company could face pressure from lower interest rates. So this one, that's your headline, Julie. So analysts at KBW, they go bearish on the name. They cut the rating to underperform, so a sell. They cut the target to 650. And in part, they're looking at valuation, and they don't like what they see. The money quote here, I think, is anytime a growth stock is trading at premium valuations, they told their clients, with 15 to 20% downside potential to consensus EBITDA, we believe a more cautious stance is appropriate.
Yeah, the stock more than doubled last year, so that's where they're coming from in terms of that valuation position. But it is not just the valuation here. They say that lower rates aren't necessarily good news for SoFi. Now, I got to say this is a little bit in the weeds here, but they talk about the way that the company does its loan accounting, and it does them differently from its competitors. And so that's one of the reasons that lower rates isn't necessarily a good thing. It says the company has some pricing power because they have a good market share, 25% in super prime personal lending, but they said they're heavily levered to fair value adjustments, the kind of accounting that I was talking about, so that is potentially problematic for SoFi.
Yeah, and to your point, stock's slipping today, but it has had a tremendous run. I mean, it is up about 85% here in the past 12 months, and the street is actually pretty much lukewarm here. Most analysts have a hold now on SoFi. Yeah,
it's interesting. Somebody was pointing out today, I can't remember where I read this, but while a lot of stocks like SoFi had a great year in 2023, they're still down from their highs where they were in 21 or 22. So it's all relative, I guess, when you look at that. Shares of Xerox, we're watching those as well. They are down after the company announced it will be cutting its workforce by 15%. This comes as part of Xerox's transformation strategy as it looks to improve and stabilize its core print business. The share's down by 12%. And, it's not unusual when you get an announcement like this for the stock to go up. But
Right.
that is not what is happening today. It looks like that investors on the one hand say, well, this is good. It'll, in terms of helping improve the company's expenses. But on the flip side, it says, what does it signal that they are doing this kind of a move here, as it is, again, in part of what they're calling this transformation strategy.
Yeah, and 15%, I mean, the reports I'm reading say that does suggest about 3,000 people. So it's significant. Investors, though, you said not too impressed, and you're right. I mean, usually on a head like that, you can see a pop, but not here. We did have some analysts on the street kind of saying, well, you know, and by the way, not a lot, no love on the street. I mean, none. There are 4 holds, 3 sells, and 0 buys at this point. An analyst did say, listen, improved 2024 free cash flow, likely limited absolute debt could help avoid a liquidity crunch here. Yet they also pointed out that's kind of workforce cut, in their opinion, could kind of highlight management's top line growth challenges here. Maybe that helps explain the kind of reaction you're seeing in the stock. And finally here, let's get a look at shares of Exponential Fitness taking a hit today. That's after Piper Sandler downgraded that franchisor of fitness brands to neutral from overweight, cut the price target to 13 from 21. So the news here, Piper cuts the stock to neutral. They're officially now on the sidelines. And the price target, as we said, goes to 13 as well. That's actually a street low, by the way. Not confident any longer in the ability of this company to actually achieve long-term growth and margin bogeys. They say reports questioning management's credibility continue to be an overhang on the stock, could likely persist for another few quarters and limit share upside, despite, they say, valuation looking pretty cheap at these current levels.
Yeah, this is a franchisor of some well-known brands, including Club Pilates, Rumble, the boxing gym, Pure Barre as well. The stock did fall 44% last year.
Yeah, it's been shelled.
What's interesting is Piper had been overweight. I think they initiated coverage back in August, and the stock is also down about 40% since that time. So they've sort of ridden it on the way down here, and now they're like, enough with this now neutral rating. So Exponential is going to be one to watch here going into 2024 to see if in-person fitness ticks up, and also to see if management can regain the credibility or the belief of the street.
Yeah, and this one is debated there, because remember the stock actually popped a few weeks ago because the team at Stifel, they upgraded this one to a buy, and their point was they thought the current risk reward reflected just too much negativity in their opinion, but clearly the crew at Piper disagrees.
Yes. All right, we're just getting started here on Yahoo Finance Live. Coming up, AI helped drive the tech sector in 2023, but can this success continue into the new year? We've dived into the top trends to watch in tech for 2024 later in the hour. Plus, Disney securing some major support in its ongoing proxy battle with Nelson Peltz. We'll have the details on that at 4 p.m. Plus, is it now or never for the Santa Claus rally? Pretty much. We're talking the latest market swings on the other side of the break. Stick around. More Yahoo Finance after this. It looks like Santa is not coming to Wall Street. Jared Blickery here with the details and what it could mean for the rest of the year. Today would be the last day of the Santa Claus rally.
Yes.
But it hasn't turned out to be much of a rally.
No, look at all this red on the board. In fact, throughout the entire world, just about. And let's check out the last 7 days, because that is what's key here. S&P 500 down 0.7 today, and it would be down 79 basis points, or about 0.8% over this time period. But why is that important? That's because this time of year, and really it is the last 5 days of the previous year and the first 2 days of the current year. And you can see here, I have these blocked off. That constitutes the Santa Claus rally. Usually it's good for 80% of the time, it's good for 1.3% average gains. However, when it turns red, that is an indicator that we might have negative returns for the entire year. And in fact, the Santa Claus rally indicator, and that's what it is, an indicator, if you combine it with two other January-based indicators, which we won't know the results of those until the end of January, those have very, very predictive power for the rest of the year. And if all three are negative, that would mean an 87% chance that the year ends red. And just take a look at what we have going on here. Throughout the entire year, or last year, at the beginning of the year, rewind a little bit, we were actually finishing January 2nd, January 3rd in the green. And look what happened. January was a very green month, and to the surprise of many people, myself included, it ended up being a very, very bullish year. So having said that, I thought we'd go to the sector action and just kind of break down what we've seen over these last 7 days, because I think this has a lot to say about the character of the rally as we find our footing in the new year. All right, over the last 7 days, check out who's winning here. Healthcare, XLV, that's up 3.1%. Then you follow that with utilities, staples, energies, financials, all of those in the green there. But the top three are pretty defensive sectors, especially staples and utilities. Healthcare, kind of a mishmash there, but you could make that argument. Now, you look at what's not working over these past 7 days, that would be tech and retail. As consumer discretionary, those were two of the three best sectors from last year. You add communication services, and that's over here, which is also in the red. You get the mega cap sectors. So looking at the Nasdaq 100 over these 7 days, if there's any predictive power, and we'll see there, we get a screen change, this would not look good for the entire year. And just, I don't want to get too ahead of myself. As I said, we still need to get results for the end of January, but as we're sitting here, second day of the year, things are looking not as bright as they were at the end of last year.
Jared, thank you for that. Appreciate it. Stocks struggling to start the year, and our next guest says market leadership needs to broaden for last year's rally to be sustained. Joining us now is Tim Urbanowitz, Innovator Capital Management, Head of Research Investment Strategy. Tim, it is good to see you. Maybe we'll start, Tim, with the Fed minutes. We've been chewing that over. It seems like what those minutes suggested, Tim, is, okay, the hikes might be over, but if and when the cuts are coming, Tim, it seems like we have some uncertainty there. What did you make of it?
Well, Josh, I thought it was very surprising overall. And what was more surprising was the market's reaction to that Fed meeting. I just don't see the advantage of coming out as dovish as they did, signaling multiple cuts next year. What's the advantage to doing that? While on the flip side, I think the negatives are very, very clear. You're loosening financial conditions and ultimately making this a more challenging battle to fight in the new year. And for us to get more comfortable to safely assume that inflation is back down below 2% for the foreseeable future, we have to get more confident that wage growth is slowing. Right now, you still have the Atlanta Fed that's estimating wage growth to be north of 5%. That's right where we were at the start of 2022 and not that far off from the peak. According to our research, we need to see wage growth slow in the 2.5% to 3% range, which is going to be more consistent with that 2% inflation. So a lot of the gains that you've seen in longer duration bonds, we think it's really important to hedge those as we head into the new year, as you could very easily see a kickback up in interest rates.
And so, do you think that the Fed is making a mistake of tone, or do you think that they will actually make a mistake and perhaps cut before they should?
Well, it remains to be seen. I think the mistake here is the signaling it to the market, because like we saw, financial conditions fell off a cliff the day of that Fed meeting. Everybody got very excited. Fed saw 3 cuts coming. Market anticipated that as 6. Still not sure I understand the math on that, but maybe there is a time this year where cutting interest rates is appropriate, but we need to see more evidence that this move down in inflation is sustained. So a lot of the conversations, Julie, that we're having with our clients right now are centered around how do we complement traditional fixed income, long duration exposure with strategies that have built-in risk management. A newer strategy that we're putting right in front of clients right now is ticker AJAN. That strategy offers a 100% downside buffer on the S&P 500 ETF over 2 years with upside exposure to the first roughly 16%. So that is one of those ways to really decouple and break the link between interest rates and risk management in the portfolio. And given the move that we saw lower in Q4, we think that is very, very important, especially in the first few quarters of this year.
You mentioned, Tim, sort of this divergence, this gap we're kind of seeing. In other words, we just got these minutes, and the Fed is obviously suggesting sort of uncertainty about if and when they cut. Meanwhile, the markets are saying you are cut, you're going to cut aggressively. You're going to start cutting in March. When do you think the Fed and the markets actually get on the same page, Tim?
Well, it remains to be seen. And quite frankly, Josh, I think the one thing that we need to keep in mind right now is that humility is the most important attribute right now above all. We've seen spurts of inflation before, but we've never seen inflation that has been triggered by a pandemic where we saw reckless government spending. We saw stimulus checks being handed out to people that were fully employed, those employers then struggling to bring people back to work. And so one of the things that we talked about in our 2024 outlook was, yeah, it's great to have a view, but there is uncertainty that is high. So more important than that view itself is finding ways to lean into the view if it plays out, but also cover your corners. And so we're seeing a lot of investors gravitate towards strategies in the defined outcome umbrella like that AJAN as a way to really help cover a lot of different bases. Because again, we don't know exactly how this is going to play out. Maybe we do see cuts earlier in the year. That's not our base view. Maybe it takes longer, but we need to prepare for multiple outcomes here.
So you talked about a couple of ways to do that, to sort of hedge against the possibility that rates will go up instead of down. You talked about it from the fixed income angle. I'm going to kind of ask you the same thing that I asked Roger from Vanguard a few moments ago, which is from an equity perspective, like, is there a group that can do well no matter the scenario?
I think there is. And if you look at the major winners in Q4, the ones that did so well when rates came down, and you look at the laggards in Q4, I would expect the opposite to play out if we see rates tick back up, because a lot of those sectors, you look at real estate, that move was entirely driven by the expectation that interest rates were coming down. One of the sectors I think that investors really should be paying attention to right now is in the energy space. Energy in particular provides a very good hedge if we do see inflation start to tick back up, interest rates go back up. It also provides a pretty nice hedge against a lot of the geopolitical tensions, which I think are being underappreciated right now. And secondarily, let's consider the starting point. What are the expectations for the energy sector in the new year? Consensus estimates are calling for under 2% earnings growth. So that's a very low hurdle for those names to clear. You have a lot of those defensive characteristics that I think investors appreciate. So I know it's not necessarily tech that everybody wants to talk about, but it's certainly something that I'd be paying attention to in the new year.
And Tim, you mentioned those geopolitical tensions, and when obviously investors get nervous about those kind of tensions, they'll duck into safe havens like gold. You mentioned you talk to your clients about equities and bonds. Are you also advising them to have gold in their portfolio, Tim? And if so, is it 5%, 10%? What are you guiding them to?
Well, it clearly has a place in an asset allocation. What we're about at Innovator is really helping our clients put more certainty around their outcomes. So defined outcome ETFs are what we specialize in, which are going to help provide known levels of buffered or downside protection when the market sells off, and then known upside exposure on the way up. So think of a strategy like PJAN. This strategy for calendar year 2024 is going to seek to provide investors a 15% buffer against losses on the downside, while simultaneously allowing them to participate in the first 14 to 15% on the way up. You look at the starting point for this year, good hedge on the downside, which people who are going into gold, that's what they're looking for. And then on the upside, you have very strong participation potential. So that's really what we favor right now, is putting that certainty, removing a lot of the guesswork. Because like I said before, again, we've never been in this situation where inflation has stemmed like this before. We need to put some guardrails around the portfolio right now.
And Tim, we'll get you out of here on this. One fun thing we're doing here as we kick off the new year, we're just asking economists, strategists, money managers, Tim, to offer kind of a New Year's resolution for investors. For the viewers who are watching now, Tim, what do you think? What's a smart New Year's resolution investors should be thinking about for 2024?
Well, I think there's two resolutions that are in particular. We have one camp of investors that are scared to death with the run-up, and they've flocked into cash. My advice there would be stay the course, be risk aware, not risk off. And then you have the other stocks only go up crowd, which are expecting the Mag 7 to produce the massive returns that they did last year. Tamper down those expectations, consider the starting point. All in all, stay on course, stay risk aware.
Tim, thank you so much for your time and for those New Year's resolutions. We appreciate it.
Great to see you, Josh.
And coming up, what are the top trends in tech you should watch out for this year? We're going to tell you on the other side.
Led by advancements and optimism in AI, the tech sector rebounding last year following a really tough 2022. So what should investors be watching out for from big tech in 2024? Joining us now, Dan Morgan, Synovus Trust Senior Portfolio Manager, with his top themes for the new year. First of all, Dan, Happy New Year. Thanks for
Happy
being
New Year,
here
Julie.
with us.
Yep.
Appreciate it. So I know you're looking ahead to themes for the new year. And I do want to start in AI here, and in particular, what is sort of next for AI. And I know you're looking at the sort of server business in particular. We saw some of that last year, notably with NVIDIA, right, for chips to power servers to train AI. What's sort of the next leg of that?
Well, that's the million-dollar question, Julie, because I'm in the camp that really I look at AI as kind of across-the-board productivity enhancement, opposed to a mega trend like we saw back in the 1990s. We had the movement towards the internet, the big capex build on that. We had the big move towards mobile phones. We had the year 2000 software bug, and you had a lot of money being spent to kind of go and, create that. And AI, we've talked before, Julie, on the show about how at a lot of times we have trouble really finding specific evidence where AI is actually creating a major increase in profits other than in the chip companies. So, I look at it more as an optimization, productivity enhancement situation. I don't see, some sort of huge, massive spend that's going to come out and we're going to see, profits doubling on certain quarters of certain tech companies. I see it kind of sprinkling across the board. So right now, the only evidence we have is really in chips. And you mentioned NVIDIA, and there's a few others that have shown profit reports that have actually increased from it, but it's really sparse beyond that.
And Dan, for viewers who are listening too, and maybe they're invested in AI-focused companies, any concern you had about the New York Times, launching that lawsuit against Microsoft and OpenAI? Is that a risk that investors need to consider? Because I would assume, Dan, there could very well be more lawsuits like that coming.
Yeah, Josh, that's a risk. Obviously, China's a big risk too, right? We constantly have China with these, pulling certain products that they're allowed to come on. That's been really evidenced in the chip sector. But, anytime you have regulators coming in and, starting to dig into it, that was kind of the first headline company you mentioned, Microsoft. You gotta remember, Meta's in that, Alphabet's in that. There's just all the big stocks, technology, have huge AI initiatives, and you start to get more regulatory oversight. That could be an issue going forward in terms of the speed of this rollout and how it can positively impact these companies. Josh, you mentioned Microsoft. Microsoft's a company that we really haven't seen any evidence of a major pickup in profits directly related to AI.
And Dan, you did mention China there, and that's, another big theme. And so I'm interested to get your take on that, Dan. Obviously a lot of American tech companies, Western tech companies, they used to, they looked at China, Dan, as this really important end market. Do you think that's going to still be true in 2024 and beyond, even as the Chinese economy is clearly shaky here and you have these rising geopolitical tensions between Washington and Beijing? Do you think how Western tech companies think about China, is that evolving and changing, Dan?
Well, Josh, you bring up a good point. I would expect them to continue to try to work around these regulations. You look at like NVIDIA. They have two key chips. They have the H100 and the A100. Well, they have two other chips that they produce that are very similar to those that they sell in the China market. So obviously these companies, in America do a tremendous amount of business there. Qualcomm does 60% of their total revenues are out of that region. Micron does about 15, just give you some numbers. So I don't think we can just turn the page on China. I think last quarter, if we looked at Apple, they did about 15 to 20% of revenues out of China. So I still think it's a huge growth area. Let's face it, it's a billion people. You can't just turn your back to them with all these regulatory going back and forth between the U.S. and China. I'm hoping that it's all going to work out and that we can kind of settle these things and these companies can move forward. But I don't see any of the big tech companies pulling out and saying we're done with China. It's just too big of a market.
Dan, looking to some of your other themes that you're watching, one of the through lines is what's going to happen with enterprise spending this year and where that IT spending is going to be deployed. So we talked about the AI piece, but I know you're focused on a couple of other themes, including software and infrastructure as a service. Are we going to see moderation or acceleration in some of those areas?
Well, Julie, if you look at the recent studies that have come out on IT budgets for this year, we're projecting about 8% growth. You mentioned enterprise software, the companies like SAP and Salesforce, Adobe, Autodesk, all these household names. That's been an area where growth was pretty muted last year. A lot of large contracts, didn't go through. CIOs were nervous about the economy. We're expecting that to grow about 13%. If you look at the data center space, which you just mentioned, infrastructure as a service, that's going to be AWS, Azure, GCP, Ali Cloud. That area is becoming much, much more mature. And if you guys can probably remember looking back at, let's say Amazon's or Microsoft's recent reports, these areas that were growing 40, 50%, for example, AWS, I think is growing at 16% right now, have really become much more mature. And I would expect that to continue, Julie, going forward. Data center was a super hot spot 5 years ago, but those growth rates are really starting to slow down. I don't really see a big change there. But hopefully for some revival a little bit into the enterprise software space. And then hopefully we can continue growing in terms of data center, but I don't think we're ever going to return back to the growth rates that we had previously, especially after COVID.
And Dan, to get you out of here on this, I want to get your views on the chip sector as well, Dan, as we head into 2024. Obviously, it's a big sector, a lot of verticals. Any specific verticals within the semis, Dan, that you'd be especially bullish on?
Well, Josh, you mentioned earlier the AI space. That's the hottest space right now. What's kind of funny is we had the big spike during COVID, work from home. So then all the chips companies who produce chips that went into laptops and PCs and smartphones did really well. And then it flipped when that cycle went down. And now we have that sector bouncing back strongly, where industrial and auto, which was strong during COVID, is actually pulled back. But we saw the bottom, Josh, in the first quarter of 23 in the chip space. We've had 10 consecutive quarters of positive growth in overall sales. There's a lot of projections out there that go from anywhere from 15 to 20% growth in revenues in the semiconductor space. And again, I think the hottest space would have to be AI. We talked about those names before within the chip space. But we are seeing a revival in some of the mature markets like smartphones, PCs, and laptops, which is about a third of the total chip market.
All right, Dan, lots and lots to sift through and think about going into this year. Really appreciate all of it.
Thank you.
Coming up, health insurer Cigna Group reportedly in talks to potentially sell its Medicare Advantage business. We'll get you the details on the other side.
The national debt reaching new levels as lawmakers gear up for another battle on future borrowing and spending. Here with what this all means for Americans, we have Yahoo Finance's Rick Newman. Rick.
Hey guys, well, we're going to get the continuation of this big spending battle that's been happening in Congress. Republicans who control the House have been saying since last summer they insist on significant spending cuts in order to pass the spending bills. So we're going to get more of that drama over the next several weeks. And as a reminder of what's at stake here, the federal national debt just hit $34 trillion, the highest it's ever been. Basically, every day it's the highest it's ever been. It hits new records every day. We just notice every time it tends to trip through a round number like $34 trillion. And guess what? Nobody has a serious plan to address this. I mean, budget analysts can tell you what we have to do. It's going to take a combination of tax hikes and serious spending cuts in the biggest programs. That's defense, Social Security, Medicare, and some other things to get the federal debt under control. It's not going to be little itty bitty spending cuts like the House Republicans are talking about. They're putting the big programs off the table. President Biden, for his part, his plan is to address this problem by raising taxes on businesses and the wealthy. But he couldn't do that when Democrats controlled Congress during the first 2 years of his presidency. So absolutely nobody in Washington has an appetite to do anything about this, even though you're going to hear everybody kvetching about how large the national debt is.
Well, does everybody include voters? Do voters care about this, Rick?
Well, they care in theory, that's for sure. I mean, polls show that voters are disgusted by what they see as irresponsible financial behavior in Washington, the fiscal follies. However, when you say to voters, well, okay, what would you do to fix this problem and reduce the national debt? I mean, nobody likes the answers. Everybody is fine if you cut somebody else's benefits or if you raise somebody else's taxes, but nobody wants to bear that burden themselves. Even the wealthy who are, really paying the lowest taxes in the civilized world fight like mad to get their taxes as low as possible and then to keep them there through lobbyists, big donations, getting, president and members of Congress elected through super PAC donations and stuff like that. So, I mean, everybody, I think, in Washington kind of understands that it's going to take a real crisis to get Congress to do something about this. And even though it's pretty bad right now, it's not at the crisis levels that it will take to trigger action. So onward we go. We're going to have $35 trillion in debt by election day. And the next president, by the end of his or her second term, we could have $40 trillion in national debt.
Trillion here, trillion there. Pretty soon you're talking about real money. I don't know. Rick Newman, thanks so much. Appreciate it.
Bye, guys.
Well, health insurer Cigna Group reportedly in talks to potentially sell its Medicare Advantage business. Yahoo Finance's Anjali Kamlani here with the details. The shares down almost 2%. And this is a reversal, right, for Cigna?
Yeah, well, we do know that they had been looking to offload that. That was part of the conversation, if you remember, at the end of last year when they were looking to combine with Humana, one of the largest providers of Medicare Advantage plans. In fact, United Health and Humana combined are 47% of that market just alone. So just to tell you where Humana stands in that conversation. But, going back to what Cigna gets from this, they're looking to offload their Medicare Advantage business in what could be up to a $4 billion deal, according to Wall Street Journal, with Healthcare Services Corp. And that is a Blue Cross Blue Shield provider that operates in 5 states in the country, including Texas and Illinois. So large populations there. They've also been on kind of a growing streak. They've had the last 3 years of just growth in their Medicare Advantage business. 2024 marks the 3rd consecutive year there, and they serve 18.6 million people. So that's a very large population that they have in the books. And this kind of speaks to, how Medicare Advantage is just kind of growing as a business per se. But for Cigna, it doesn't have as large a share of that. It's just about 2% of the market. So that might kind of be why a little bit.
And why is Cigna offloading the Medicare Advantage business now? Is there a reason at this moment it makes more sense?
Yeah, Medicare Advantage, while it is a profitable business, based on Humana and United Health alone, as you can see on your screen, the Blue Cross plans have about 14% of that business. So it's a good fit there. they have been under a lot of pressure, right? Medicare Advantage has come under the government's, microscope for overcharging, delaying or denying care. They've had hospitals drop plans because of these practices, because they feel like these patients aren't really worth the struggle to get paid. And so we've had some of these problems with Medicare Advantage pop up since 2022. Up until then, it was kind of on a growing streak. In the last 6 years alone, you kind of saw that growth. 51% of Medicare eligible enrollees are on a Medicare Advantage plan, and that's up from 19% in 2007. So you can see that growth. You saw how it works. And the way that Medicare Advantage works is that these insurers basically get a set price per patient, and they get to profit off of that if they don't use as much of that money. So that's where the bonus is, right? But that's exactly the thing that has landed them in hot water. And so if you don't necessarily have as large of the market share, it kind of makes sense to not necessarily push forward if you just have 2% of the market.
All right, Anjali, important story. Thank you. Coming up, closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
You have the closing bell on Wall Street here, second trading day of 2024 in the books. And also, too, the Santa Claus period is now in the books, and it wasn't such a great finish. Remember, this is the last 5 trading days of the year and the first 2 of the new year, as our Jared Blickery was just outlining for us. That can be sort of indicative of what we're going to see from January and potentially from the whole year. So I'm just getting the latest numbers here and what we saw in that period, and it was a decline of 0.8% if you look at the S&P 500. So that's not fantastic. At the same time, there are some winning streaks that have been interesting as of late. There are some S&P 500 stocks that are currently set for 8 straight days higher. You want to know what they are?
Just tell me.
I'm going to tell you what they are. Coke is one of them here. Aflac is one of them. Hershey. So we've got some of the consumer staples names. Assurant on the insurance side as well. Kraft Heinz is one of them. Johnson & Johnson. So it's sort of a mixed bag. There's not really a big theme here, except maybe a lot of them look like they're sort of slow and steady guys, right?
Yeah.
You got like McCormick on that list as well. AT&T, T-Mobile on that list. So kind of interesting here, these stocks where we have been seeing consistent gains for the past 8 sessions versus the market that hit a speed bump.
Yeah, but overall, as you said, market bumpy start here.
Bumpy start to
which
the year.
we did have some smart strategists saying, listen, maybe not totally unexpected after the kind of rip we saw in Q4, but interesting.
No, I mean, it's a bad start to the year. I'll have to run the numbers here to see the last time that we had the first 2 sessions of a year that were this negative, pretty negative for the Nasdaq in particular, where we're seeing that tech pullback. And as we talked a little bit about yesterday, it is not unusual to see something that did really well last year then start to kind of roll over to start the year. The question is, how long is that going to last now? I mean, 2 days is nothing in the grand scheme of things in terms of market trends. But still, it's, something
Notable.
to give people pause. Exactly.
All right.
Notable.
Let's get to some other notable movers today. We're going to start with Ford. We're calling nearly 113,000 F-150 vehicles. The National Highway Traffic Safety Administration citing an issue with the rear axle hub. So this was not a good headline, and it sounds like the F-150 pickup owners who have the Trailer Tow Max duty package are the ones who could be impacted here. That's who we're talking about. We're calling 113,000 trucks because its rear axle hub may break. Doesn't sound like, according to reports I was reading, Julie, there's a fix right now that Ford is saying a solution is under development. So owners, contact dealers for an interim repair. Important to emphasize, no known accidents or injuries related to this situation, but it did take the stock down today. You can see a slide there.
Yeah, I mean, it doesn't sound like this is a major fix here in the grand scheme of things. However, this is the major product from them in terms of their truck line.
Yeah,
the F-150 is a cornerstone of the Ford lineup. And so seeing a headline like this on top of what has already been, kind of a rocky period, as you can see from the stock chart there, not how Ford likely wanted to start 2024.
Yeah, and remember, Ford CEO Jim Farley has talked about this as an area he's focused on. Reducing recall and warranty costs is something he said has been a priority. So not a good headline. Investors reacting to it. Analysts still pretty split on this name, by the way, even as the stock has basically gone nowhere in 12 months. 14 buys, 13 holds.
All right, let's talk about another one here. It's AMC. The stock is at an all-time low in today's trading session, down another 8.6% and marking continued turbulence for the stock. Now, a couple of things that have been going on here for AMC. The company has been trying to push its debt down by doing equity offerings. It did a bunch of those in December at the market equity offering, raising about $350 million over the course of the month. Also yesterday, B. Riley cut their price target on AMC to $12 from $15. They've got a neutral on the shares. And they talk about the box office last year just not being great because of the effects of the strikes.
Yeah, of course, a meme stock darling. We all remember along with his GameStop, BlackBerry, the Wall Street, bets crowd piled in. At one point, remember, AMC trading around $340, but has since crashed back down to earth. Stock's down around 85% in the past 12 months. But Adam Aron, right, remains undeterred.
Unbowed.
Yeah, on the posting on X, New Year's Eve, slammed what he called the prophets of doom about the company were wrong, he wrote, said AMC still here, still innovating, still blazing new trails. Now, what do analysts who actually cover the name think? Not so much, not a single buy left on the name here.
Yeah, no, they're not. And I love, though, how he addresses the apes, right? That's how the fans of the stock have been addressed. And he was the silverback, kind of like the chief elder ape, if you will. We'll see what happens going here into this year. I mean, there is a relatively full slate of movies, but will it be enough to get people into the theaters? I mean, there were some hits. The Taylor Swift movie, Eras, was good for AMC, but it just wasn't good enough to salvage the full year box office.
Yeah.
All right, let's talk about another one that has been, by the way, memified from time to time. We're talking about rocket companies hit with a downgrade from KBW to underperform from market perform. This coming as Wells Fargo has also gotten more bearish on the stock. Those shares down by 6.5%. KBW basically looking at the valuation and the company's relative weakness in the purchase market here. He's setting the price target at $10.75, which is obviously below where it is at this point in time. Rocket had sort of an interesting couple of years as well. It was down sharply in 21 and 22 after going public, and then last year doubled, but still has not recouped those losses that it experienced from the highs, that is, since it went public.
Yeah, I mean, a theme here really seemed to be with these analysts. It was, in part here, it was a valuation call. I mean,
Right.
at least, you looked at Wells Fargo, they said, listen, bottom line, the company's still well positioned. It's a good company, high quality, but its valuation, it just now looks fair, and they're kind of, in their words, struggling to pencil in material upside from these levels. And the stock has, I mean, listen, one buy left on the street at this point, we should know it, but what a move. I mean, over the past year, it is up nearly 90%. So
Yeah.
you would expect after a move like that, some folks do move to the sidelines.
I mean, KBW also, though, pointed out that the company's market share has fallen in refinancing in particular. So that's a little bit of a fundamental case as well, not just on the valuation question.
Moving on, the tech-heavy Nasdaq falling for a second day here. It's after kicking off 2024 with its worst daily decline in nearly 3 months. As tech sees a rocky start to the new year, we're taking a look at which names investors should set their sights on. And here to discuss is Jim Kelleher, Argus Director of Research. Jim, it's good to see you. Listen, tech was the place to be, Jim, in 2023. If you piled in January 2023, you're feeling pretty good. As we move now to 2024, Jim, let's just get to some picks where you think investors should be committing capital. One name is well known, certainly, Jim. It's NVIDIA. It has had, that stock has been, we know, just a rocket ship. It's up, Jim, I think, 230%. In the past 12 months. You say, though, it's still a buy. Why, Jim? What are the catalysts that are going to get NVIDIA still moving even higher from these levels?
Well, Happy New Year, Julie and Josh. Yes, Argus has produced its top picks list. And before I get to NVIDIA, I'll point out that it is a little differently skewed than a year ago. Last year, in our list, we probably had as many or more technology names than we have consumer names. This year, we have something like 8 consumer names between staples and discretionary, and only 4 technology names. So we also feel the market had a little bit of a rich run last year on the growth sectors. The other thing I would point out, though, that the list is mainly comprised of new companies, I would call them. I mean, yeah, there are some traditional names on the list you'd recognize, and now NVIDIA is one, but also Coca-Cola. But generally speaking, a lot of these names didn't exist, say 2 decades ago, or at least a decade ago. So we don't, for example, in the banking list, there's no money center banks, and in the healthcare list, there's only one with traditional pharmaceutical. So definitely a lot of new stuff in the list and in the sights of our analysts, so to speak. Now, speaking of NVIDIA. Yes, it's had a great run, but the amazing thing about NVIDIA is that the age of generative AI is really getting started, we would say. So they are selling, to use the tired metaphor, they are selling picks and shovels at the AI gold rush. I think it's worth noting, Josh, that while there's a lot of hype about generative AI, running a large language model requires a massive amount of computing power and software support. It's not something you can do in a wire closet or even in a enterprise data center. It's something that has to be done offsite, usually in a massive cloud-based data center. And we've not really reached the age of cloud delivery of generative AI as a service. That's starting, though. And not only is NVIDIA providing the GPUs and the ARM-based CPUs and the CUDA software and the inference training tools and models, not only are they producing all of these things, but they're also one of the first people to develop the ability to deliver AI as across the cloud. So AI as a cloud service. So, generally speaking, even though the stock has run up tremendously, the revenue has run up more. The profitability is following the revenue and accelerating from there. So we don't think it's all over for NVIDIA. And it is, we will point out, it's a very bumpy stock, had a terrible 2022, but a good 2021 and a good 2023. So we still like the stock here, Josh. So sorry for the long-winded answer.
No, we appreciate it. I did one follow-up on NVIDIA, Jim, is, when you have the kind of run NVIDIA has, it does attract competition. And NVIDIA has it. It's AMD, Intel, the big cloud giants. Who do you think poses the most competitive risk, Jim?
So I don't think NVIDIA's position is at risk, but I do think AMD is a great way to play the rise of not just because they're a GPU maker like NVIDIA, but also because they're winning share in the data center for traditional x86 based computing. So they're winning in CPUs also. They're taking share from Intel, and their Ryzen processors and their EPYC server processors take share. And by the way, in addition to the need to have GPU compute in generative cloud large language models, you also need a lot of traditional CPU computing power. So they get to attack both markets in a way that NVIDIA actually does not get to. So I would say even though they are somewhat similar companies in that they're primarily semiconductor companies, I think AMD is the next big mover in this space.
Jim, there's another name I want to ask you about that is not one, even though it's a big company, it's not one that we talk about as often, and it's Arista Networks. Also one of your picks here, and one that you think is going to benefit from the continued AI boom. This, like NVIDIA, had a good year last year, not quite as good, but it did almost double. So where does it fit into that whole ecosystem? Well,
so, it's just a great business they're in anyway, connecting data centers. We look at the massive amount of computing power needed, but all that information, all that data needs to traverse from data center to its ultimate destination. So you need networking elements. They're truly the first real cloud-based networking company, and they tend to serve what they call cloud titans, which would mean, basically Google Cloud, Microsoft Azure, AWS of Amazon. So they do serve that vertical, which is a big part of their business, but they also serve large enterprise customers, and they're pushing into smaller enterprises, and they're pushing up into the carrier space. So, they originally guided that after a great 2022, their cloud business would be down in 2023. And then, of course, here comes ChatGPT at the end of 2022, and then it gathering momentum through the year, and everyone wanting to be in on the gold rush. So their cloud business related specifically to generative AI has really taken off. And, they're another one where the sky is the limit until we see how this business really shapes out. But because it is so early in the generative AI delivered as a cloud service day, we're not sure how big it's going to be, but we will see. And we certainly think Arista, in the same way that NVIDIA is uniquely positioned to drive things in terms of fueling large language models, we think Arista is uniquely positioned to deliver generative AI across the networking element.
And Jim, I'll get you out of here on this. One last name I want to get your thoughts on, ASML. You think it's a buy here, Jim? Listen, they just made headlines. You saw that headline, canceling shipments of some of their machines to China. But you say this is still a buy in 2024. How come?
So Josh, they're in a business that's a little obscure if you don't, in terms of semiconductor capital equipment. They do extreme ultraviolet lithography, which is printing the so-called the photo masks that produce really, really tiny semiconductors. And increasingly, these cutting edge semiconductors are, being produced in what they call a process node of, say, 7 or 3 nanometers. A nanometer is a billionth of a meter, so that's the width of the wire circuit. There's millions of transistors on these semiconductors, and eventually billions. If you really want to get, to efficiency, you're going to need extreme ultraviolet lithography or EUV lithography machines. ASML is just this year shipping its newest Highgate or High NA, its most advanced machine ever. Intel's taken delivery. TSM will take it. Samsung, all these others will be buying these big and expensive machines, but they're necessary for the roadmaps that these companies have in mind going forward. So I think ASML will replace. Don't forget we have the CHIPS Act. There's the equivalent acts in Europe and in Asia. Everyone wants to have semiconductors produced onshore as a matter of national strategic priority. It's not just us. So any business any foregone revenue from China will be sent elsewhere in the world, particularly North America and Europe, and then eventually the rest of Asia as well. So I do think the Biden bans on shipments to China do represent a headwind for ASML as they do for NVIDIA, but for both companies, they're ready markets for their products all around the world.
Well, we'll see how this year goes then as a result. Jim Keller, great to see you. Thanks a lot.
Thank you, Julie. Have a great, happy New Year.
You too. We are watching oil prices as well today. They're moving higher on heightened tensions in the Mideast, including a protest. Ines Ferre here with a look at today's action. Hey, Ines.
Hey, Julie, and today we saw oil prices surge more than 3%. This is partly because of a supply disruption at a Libyan oil field. That oil field, which produces about 300,000 barrels a day, was disrupted because of protests. And then you also have, of course, concerns around security concerns at the Red Sea because of Houthi rebels that have been hijacking or attempting at hijacking vessels at the Red Sea. You had yesterday's price action also showing you sort of the volatility that we've seen over the last couple of sessions here. You saw when Iran, which backs the Houthis, Iran had sent a warship into the Red Sea, so that sent oil prices higher. But then we went into negative territory for yesterday, and today we are seeing oil prices which jumped back up again. So a lot of uncertainty, security concerns around the area as well, that's sending prices higher. But you also have something very important that came out today, and that is a statement from OPEC. And that statement, we have it, that we're going to put it up for you on the screen, basically saying that its members vow for unity, that they are committed to sharing objectives of unity. And that statement is very important because the market has also been contemplating where oil prices are going to go with the OPEC production cuts this year. You'll remember that with those deepening of cuts that OPEC announced at the end of last year, that oil prices went down because the markets had some skepticism about those cuts, saying basically that they were voluntary. Then you had Angola, which has been a member for 16 years, which said that it was leaving the oil cartel. So the markets have been kind of skittish about what would be happening with these production cuts. There's also increased production in the U.S. that analysts are saying are going to make up for those output cuts from OPEC. But this statement is basically saying, look, we are united, and there is a reported meeting that will be taking place among OPEC members at the beginning of February. Guys.
We'll be watching all of that very closely. Thanks, Ines.
Thank you.
Disney securing some major support in its ongoing proxy battle with Nelson Peltz. The media giant securing the support of activist hedge fund Value Act for its board nominees. Separately, Blackwell's Capital will nominate 3 directors of its own to Disney's board who side with CEO Bob Iger's current strategy. Joining us now, Jessica Tunkel, deputy media editor at the Wall Street Journal. All of this trying to counterbalance Nelson Peltz and Tryon. There's like this activist battle that seems to be going on here with Disney at the center. What do we make of it here? And sort of how do we figure out who the winner could be in all of this?
So today's a bad day for Nelson Peltz. As you may recall, his firm Tryon started an activist campaign last year against Disney, saying they wanted more cost cutting. Disney's CEO, Bob Iger, who had just returned as CEO, implemented a very aggressive cost-cutting plan. Peltz backed off. Then he came back because he was unhappy again. And this time he brought Ike Perlmutter with him, who is an investor in Disney and wants to be on the board. He recently nominated Jay Rizzullo, former Disney executive, to be on the board. But Disney has all these other shareholders, including Value Act, which has a lot of heft. backing them now. So I don't know where this is going to go for Nelson Peltz. It doesn't seem like it's boding well for their campaign.
And another big story, want to get your take on, Jessica, in your world, was Paramount Global, which is a fun one. How do you think that one plays out? You know, I mean, it merges with Warner Brothers Discovery. What do you think?
So we've all been waiting, right, for the past couple of years for like, what will the next big M&A deal be? You can't have this many streaming services. It's too expensive to do streaming for these companies. They're pouring billions of dollars into it. So Paramount seems to be the first company that is going to sell. From whatever sources tell me, it sounds like a deal is in the works. Sounds like something will happen in the next several weeks. We'll have to see. You know, as we've reported and others have reported, Sherry Redstone, the controlling shareholder of Paramount, has had conversations with Skydance to sell her stake or all of Paramount's parent company, National Amusements, to Skydance. There was also a lunch reported between Warner's CEO, David Zaslav, and Paramount CEO, Bob Bakish. I don't think, my reporting tells me that that is not going to be advancing, but it's too early to say.
You know, I'm curious of your take, Jessica, coming out of 2023, how the media moguls have fared, right? You look at Bob Iger under fire at Disney, at least from Peltz, even if this is a bad day for Trian. You know, you look at David Zaslav, who maybe now is trying to, after he built this thing, maybe is now trying to sell it. Like, you look at the strikes and how these various executives interacted with the various unions. I mean, did they overall, how do we assess that last year for them?
You know, I think that everyone kind of had a realization moment, all these executives, where they realized, oh, maybe we shouldn't have gone all in on streaming. Maybe that was a mistake. Maybe we shouldn't have, we were getting a lot of money from these cable companies. Maybe we should have continued the course with that. I think it's a little woulda, shoulda, coulda, honestly. Like, there had to be some changes. Everyone had to evolve. We all knew there was going to be years of bumpiness, and this was going to be a tricky transition. I think it's obviously a lot harder than we anticipated. For some of these companies like Paramount, they just don't have the scale to do it on their own. Disney, I think, will be able to manage through this, but it's going to take some time.
And Jessica, I want to get you out of here on this. You recently wrote a great piece, which spoke to me personally, because my 4-year-old Jessica makes a beeline for YouTube, right? That's it. It's all about YouTube. And apparently, Sid is not alone from your reporting.
Yes. So kids are going to YouTube and not going to streaming services. You know, we had some reporting that showed that from Nielsen that Netflix is seeing the number of 2 to 11-year-olds that are on Netflix decrease from, you know, around 25% to 21% in September 2023. Meanwhile, YouTube is slowly increasing from 29 to 33%. You know, as a parent, we've all seen it. We see our kids going to YouTube. They like these little bites of content, and they like the way it's served to them. So I think all the streaming services, including Netflix, are figuring out how do we work with YouTube to kind of get these kids back to our services rather than see them as an enemy.
Jessica, thank you so much for joining us today, and everybody should check out that piece. It's great, especially if you have kids. Thank you, Jessica.
Thank you so much for having me.
Still to come on Yahoo Finance, what investors should be looking for in the 2024 REIT market. We're going to talk to an expert on the other side. Commercial real estate is putting a lot of strain on banks, with many CRE loans being more than the property values themselves. But our next guest says the real estate investment trust market is an interesting play after finishing strong in 2023, despite negative CRE headlines. For more on what investors should be looking for in the 2024 REIT market, we bring in Rich Hill, Cohen & Steers Head of Real Estate Strategy and Research. Rich, it's always good to see you. You know, it's a new year. People are thinking about making changes to their portfolios. Maybe they're thinking about adding in REITs. Maybe just broadly to start, Rich, as you look now to 2024, to the REIT market, does it look strong, healthy, bullish?
Yeah, sure. Well, maybe I can just recap a little bit what happened in 2023, because I think it's useful to look back as we start to look forward. Look, the reality is listed REITs had a pretty solid year. They were up more than 11%. And I think if you told many people that was going to occur this time last year when we were facing 5 bank failures and, oh, by the way, 10-year treasury rates hitting 5%, I'm not sure many people would have believed you. And certainly it was a wild ride for listed REITs in 2023. They were up 10% in January. They were down more than 10% year to date in October. And they finished up 11% for the years, as I mentioned to you. But I think what you're really dealing with here is three important points. First of all, we've always said that recessions create attractive entry points for listed REITs, with the very best returns coming when we transition from recession to early cycle. We think that's occurring. The second thing that's happening, which is really important, is that the very best returns for listed REITs usually come in the aftermath of the Fed stopping hiking interest rates, which we think we're on the precipice of. And the third point here is that listed REITs are a leading indicator for the private market in both downturns and recoveries. So we think listed REITs have priced in a lot of the headwinds that are facing the broader commercial real estate market, and you'll continue to see a lot of headlines about that in the year ahead.
Rich, all listed REITs are not created equal. So where are you seeing the most opportunities right now within REITs?
Yeah, sure. So it's a great question. And I think there's really two big misconceptions about listed REITs. First of all, that they don't have strong balance sheets. They do have strong balance sheets. LTVs, loan to values are less than 35%. We focus on that a lot. The second point is that office, which dominates a lot of media headlines, is a big portion of listed REITs. They're only around 3% of REIT market cap. So that brings me to your question. There are around 18 different subsectors within the listed REIT umbrella. People like to focus it as one singular asset class, but it's really 18 different subsectors that can behave differently at different points in time. What do we like? We like things like data centers right now. We think data centers are going through a huge growth boom, driven at least partially by AI. We're big believers in single family rentals. There's not enough housing in the United States. Buying a home is really expensive. Renting a home is not too cheap as well. So we like single family rentals. We like things like seniors housing. And believe it or not, we like high quality owners of regional malls as well. So there's always an opportunity to find value in the listed REIT market.
And Rich, what about hotels? I mean, the consumer still spending, still resilient. Do you find those attractive?
Yeah, we're a little bit more on the sidelines, only because we have maybe a little bit more cautious view on what the economy is going to look like in 2024 and beyond. We think the market's pricing in certainly a soft landing at this point. We're probably a little bit more cautious on that outlook. So we have a little bit more of a defensive bias in our portfolio. We're looking for high growth stocks. Things like data centers where there's strong growth, single family rentals. Not to say we don't like hotels. We think they're good, strong businesses, but we think there might be a better entry point.
Rich, of course you're familiar with the concerns being raised about office REITs in particular, and the refinancing wave that could hit this year and potentially affect a lot of bank balance sheets that are holding some of that debt. I'm just curious your take on that, how severe it could potentially be.
Yeah, the concerns are real and they're valid. We have around 45% of all commercial real estate loans coming due over the next 3 years. That shouldn't come as a surprise. Usually you have around 15% of loans coming due every single year, but there is certainly a big wave coming due. And what's really pressuring the commercial real estate market right now is not really fundamentals. Fundamentals are on pretty strong footing. What's happening is return of interest rates and financing costs to an old normal environment that we saw prior to the GFC. And that is putting significant pressure on valuations. Things like office are going to need a lot of new equity infusion to be able to refinance. That doesn't mean that some loans won't be modified, but you are going to see some pretty significant equity infusion. On the other hand, we think the totality of the commercial mortgage market is actually still underlevered because we've seen a lot of property price appreciation since 2012, and some of the properties like multifamily and industrial have done quite well. So all things considered, there is some real risks in the commercial real estate market. I sort of think those are known knowns at this point. And maybe the rhetoric went too far bearish that something more pragmatic in the middle that is still a challenging environment ends up being a bullish outcome.
I do want to dig into office a little bit more, though. I mean, just on an anecdotal basis, like, things are empty, Rich. Right? Occupancy seems to be pulling back. So are we not in an appropriate valuation for those? Is there potential for more downside with those properties, or do you think that is sort of priced in? And what happens to those properties where maybe we're not going to see tenants come back?
Yeah, it's really important questions that you're asking. So let me come back to the point I made at the very beginning that listed REITs are leading indicators for the private market. Listed office REITs were down more than 50% at one point. They're still down considerably. They bounced back a lot over the fourth quarter of the year, but they're still down considerably. Some of these listed REITs are trading at implied cap rates in the high single digits, maybe even low double digits. The private market's not there yet. So I think it is fair to say that the private market in the office sector still has a way to decline. By the way, that's not unique to office. Multifamily probably still needs to feel some pressure. Industrial still needs to feel some pressure. The private market's probably only 50% of the way through the correction that we think will likely occur, with the trough occurring in late 2024, early 2025. So back to your question about office. Look, there's two things happening here. First of all, we built too much office over the past, 2-3 decades or so. So that's number one. Number two, look, the impacts from work from home post-COVID are real. So I don't want to beat around the bush. But I do think the market is, and this is sort of a cliche term, so I'm sorry for using it, is painting the office market with too broad of a brush. High quality, new, clean and green office, so to speak, is actually really well positioned. Occupancies are quite high. And I think I can make the case that we're undersupplied in the United States of high quality office. The real problem is we have a whole host of older properties, so properties built in the late 70s, early 80s, that have had no renovations or redevelopments done over the past 3 decades. People don't want to really work in those properties. So you're sort of facing a dilemma right now. Do you put a lot of money into those properties to make them competitive again? Money's not free. Or do you go invest in a new property that's new, clean, and green and can drive rents? So the real challenge here isn't the totality of office market. It's all the old quality properties. What do we do with them? That's I guess you could call it the $1 trillion question. You hear a lot of people talking about maybe office to multifamily conversions. Those are easier said than done. The reality is, I think you probably need a public-private partnership where you create mixed-use developments where there's, not to say work, live, play, but you can have places to work, places to live, places to shop. I think those could really be something that's pretty important. Now, maybe the solution here is that things have gotten so bad that we have to recreate it. But there's not an easy solution here, which is sort of why we're still on the sidelines with the office sector in the listed REIT space, despite valuations screening cheap.
Copy that. Thank you so much. Deep expertise on this issue, clearly. Rich Hill, appreciate it.
Thanks for having me.
Coming up, we're going around the horn and checking in on some of today's top trending stories. Josh, the other one, Pras and Maddie are standing by with what's to come.
Yes, Julie, the other Josh is here. We are in our new part of the studio, very excited. Inflation came down for most of 2023, guys, but is that trend going to continue in 2024?
Josh, I don't know. I might have to pay more for my ad-free Amazon Prime coming up, though. I'm not sure about that.
All right, we got to debate it all after this.
one where I think it's interesting that you're saying that Amazon's actually going to make money off this. They saw the success of Netflix Prime. I was considering myself like, I can't pay. I don't want to watch ads ever again. I will pay to not watch ads.
Wow.
But if everyone is now making me pay more, like I said, I'm going to start cutting back on services. But maybe I'm wrong. Maybe people are like, you know what? I'll watch ads for the better pricing, the better discount. Are we coming back to that?
I think it gets more people in. Right now, it's easier with how high these prices have gotten to say, okay, I'm only going to do 3 of them, right? You only want to spend 50, 60 bucks, whatever your limit is on streamers. But then when you start offering the ad tier, some of these are under $5.
Right.
And then you're maybe, okay, I'd actually opt back in, right? Because it's a low number. So it gives that low number option, and then you're just getting more people into the ecosystem. Yeah. We know it's an ecosystem play for Amazon.
Well, that is exactly the point, Josh. This is why Netflix originally had more options for ad tier models for folks, and then they ended up dialing that back and just having that cheapest option and then a mid-tier and a more expensive. Originally, there was an additional option in there, and I think it was because they realized that they really only wanted to have that really entry-level market share gaining opportunity, and they didn't really need to get a lot of interest from the other one. They could just make people pay the more expensive streaming option.
Maddie, we didn't get to your favorite option on streaming. We're going to have to do that off air. But coming up next, we're going to bring you what to watch tomorrow. We break down the stories you need to know to start your Thursday.
There is some optimism around a comeback year for deal making. According to a recent KPMG survey, 2/3 of M&A decision makers expect more deals this year compared with 2023. But our next guest says there are some wrinkles still left to iron out. Joining us now is Cameron Ansari, venture partner at Headline. Cameron, it's good to see you again. So when we talk about M&A here, we've talked a lot here about some of the regulatory obstacles, but maybe there's some others as well to the floodgates opening this year. What's kind of tops on your list?
Sure. I mean, look, it's been a tough year for M&A in 23. It was down about 17% globally. to 2.9 trillion from the year 2022. And M&A stands for mergers and acquisitions. It might as well have stood for meager and absent, because there are very few deals, in particular in the tech sector, smaller deals, notwithstanding the largest deal that was announced at the end of the year, that was Cisco attempting to buy Splunk, which hasn't closed yet. But regulatory is the biggest issue. I think it lacks, creates a lack of predictability, and the regulatory scheme has gotten even more complicated now that you have 4 or 5, 6 bodies you have to go to. It's not just the U.S. In the U.S., you have both DOJ and FTC, and then you have the UK with Brexit, EU, in some cases China. I saw a deal where they had to go through the Saudi Arabia antitrust group. So depending on how many countries you're operating in, and for most tech companies, it's going to be probably 50, 100 countries that they're in. You're going to have to go through a lot of regulatory hurdles to have a deal go through, which is why you're seeing mainly private equity buyers in the market in the tech space.
And Cameron, I wonder if another issue is just how long it can take to get these deals done. I mean, you think about Microsoft and Activision, Cameron, or Broadcom, VMware. I mean, these deals can take years at this point. I wonder how many times you might, a CEO is thinking, a deal makes sense, but then starts to think through how long it's going to take to get this thing over the finish line, just says it's just not worth it.
Absolutely. Look, I mean, as a venture investor, and if you're on the board of one of these companies, if you're a founder, you have multiple paths for exit. You can do an IPO, you can do M&A, you could do a recap with a private equity firm. And at this point, the corporate M&A route is probably one of the least desirable, just because of the fact that, like you're saying, it could take forever. There's a lot of risk, it lacks predictability, and the time and cost. I mean, you might be stuck in a process for 12, 18, 24 months and then not have it work out. And I've been in that movie where you go down the road. A company called Billy, which Procter & Gamble tried to buy. We went, in the process for probably 12, 18 months before the government said they couldn't. And then Schick, another buyer, was able to come in and buy it. So we weren't exactly sure why one was allowed to and one wasn't. Is a sort of, a bit of a parlor game to figure out exactly what's going on. But that, gives you pause. And so you think, well, if there's a private equity buyer, a financial buyer that can come in and give us a similar return with far less risk in terms of closing, that's a better outcome. And that's why, the private equity guys have been cleaning up on the public markets, buying all the good software companies that they could afford, kind of between that $1 and $10 billion range. But I think that's going to slow down too, because all the best ones have been picked off, and now the ones that are left are kind of the larger ones that are probably too big to buy unless you get a big consortium together.
Well, and even the private equity guys weren't super active in 2023, right?
No.
And then the other option that you mentioned, the IPO market, well, that hasn't been so open either. So what happens?
That was even worse.
Yeah, so what happens this year, I guess, to these sort of richly valued, or at least large, privately held companies that are looking for that exit? Do they just have to wait longer?
I think there'll be some waiting. I think you are going to see the IPO market pick back up, particularly because the last kind of 4, 5, 6 months of the year, the market was doing much better. And, it's been a choppy couple of days here in early January. But most folks, given what the Fed's about to do in terms of probably pausing and maybe even cutting rates, inflation having been sort of curbed for the most part, you're seeing more optimism around deal making. I'm seeing it on the venture side with term sheets going out and companies getting funded. So I think that you're going to see some of these IPOs that have been in the kind of waiting room for a long time, Databricks and Arctic Wolf and Intercom and Reddit, and and the granddaddy of them all, Stripe, if and when they come out, probably maybe at the end of the year, even 2025. I think you'll see these other guys start to come out, and there'll be a thawing in that space. On the M&A side, I think the tech market is going to be slow still. I mean, what's the last deal that you saw Google or Facebook or Apple, one of these guys do? Because they're just, I think, too reticent to do a deal given the antitrust risk. And the only one of the large tech companies in the U.S. that's been active is Amazon, and they've been buying non-core assets, things like MGM Studios or Whole Foods, which are far less likely to get blocked in terms of antitrust.
And Cameron, I'll get you out of here on this. You're a venture investor, so you're meeting with a lot of smart, hungry entrepreneurs. As we start the new year here, Cameron, any particular verticals or sectors that you're finding especially interesting here?
Sure. Well, look, in the spaces I invest in, which are mainly fintech and e-commerce, in the fintech space, we still think B2B payments is really the area that's been underserved and underpenetrated. The only real B2B payments company at scale that's out there and is public is Bill.com. There are a handful of others that are smaller, but most of the big scaled companies you think about that you've heard of in the fintech space, like PayPal and Stripe and Square, and Venmo and all these businesses, they really enable consumers to pay businesses or consumers to pay each other. They don't help businesses pay businesses, and that's a much, much bigger market than all of those. So I'm actively looking for companies in the B2B payments area, and that's a space I think is going to be very, very active this year.
Cameron, we always love having you on the show. Thank you for your time. We'll see you soon.
Thank you. Happy New Year.
You too. Time now for what to watch Thursday, January 4th. On the earnings front, we're getting results from Walgreens and Conagra, both reporting tomorrow ahead of the open. Walgreens announcing 2024 first quarter earnings and Conagra releasing second quarter earnings for 2024. Now to the labor market, new jobless claims data, the weekly report of people filing to receive unemployment insurance. It's coming out in the morning. Economists forecasting a slight uptick from the prior week and will give us some more insight on the health of the economy going into Friday's big jobs report. And moving over to the housing market, the first look at mortgage rates of the new year coming out at noon. The 30-year fixed rate dropping last week for the 9th consecutive time, but still well over 6%. And as we say goodbye, tune in tomorrow for our series Goodbye or Goodbye, where we help you navigate the best moves for your portfolio.
Well played, my friend.
I thought I really sold that one.
You really sold it. You've been practicing, I know. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Plus, goodbye or goodbye.
Pretty good. Not bad.